Episode 23 – National Accounts. It is often assumed that while, for the protection of shareholders, it should be a legal requirement for private businesses to keep a set of books composed of a balance sheet and a profit and loss account, it is not necessary for a nation-state to be subject to the same demands. But what if this assumption is incorrect? According to the social credit analysis of Major C.H. Douglas, not to be confused with Chinese social credit, a national balance sheet and a national profit and loss account are indispensable preambles for implementing the national monetary policy that was introduced in Episode 10. You will recall that the purpose of a national monetary policy is to provide the real economy with a properly designed financial software so that it can fulfill its true purpose to the extent that this is physically possible. The delivery of the goods and services which people need to survive and flourish with the least amount of labor and resource consumption. A properly designed financial software was presented, in turn, as an honest system, which accurately represents, in the virtual world of numbers, the objective facts concerning the real world of physical economic realities. It would provide us with a truthful picture of both our potential and real wealth. Now, the first step in setting up a national monetary policy that actually serves the authentic common good is for the nation-state to assert its sovereignty over the financial system. Nature abhors a vacuum, and if the nation-state fails to correctly determine the overarching policy of the financial system, private interests acting through the medium of the banking system will manipulate that policy in their own favor and at the expense of the common good. Once the sovereignty of the public authority has been re-established over the financial system, the second step in implementing a national monetary policy is to task a national credit authority with the introduction of a national set of books. By measuring the financial position of the national economy with respect to both productive capacity and surplus production, we can transform the financial system into an honest system, i.e., one that will accurately reflect the physical economic realities. This measurement would be accomplished by a national balance sheet on the one hand and by a national profit and loss account on the other. A national balance sheet would present a realistic valuation in monetary terms of all of the economic resources and concurrently available production of a country over and against which money could be issued. The economic resources, i.e. land, labor, real capital, and various intangible goods, and the available production, i.e. the flow of goods and services coming onto the market, would be classified as the country's assets, while the financial demands made on those assets, chiefly in the form of the money supply, would constitute the country's liabilities. This way of representing a nation's balance sheet makes it clear that it is the productive capacity of a nation, alongside the goods and services that are on offer, which ultimately give value to money. The relevance of the national balance sheet for the financial facilitation of production under a national monetary policy is as follows. One can rightly expect, in any given case, for the value of assets on a national balance sheet to significantly exceed that of the liabilities, as no country has ever managed to call in the entirety of its productive capacity. This net worth, i.e. the value of national assets minus national liabilities, would form the basis upon which additional money could be issued. It shows us that the nation is creditworthy, and it gives us some idea as to the extent of that creditworthiness. So long as there are unmonetized items in the registry of national productive assets, additional credit for production could be created and lent to productive organizations so that this potential might be actualized in the form of additional goods and services. Insofar as there are also unmet needs amongst the members of the population, due to a physical lack of supply, the additional producer credit necessary to increase the flow of production not only could but should be created and issued to the appropriate agencies on behalf of the community. A national profit and loss account, on the other hand, would compare the value of what a nation produces with the volume of claims in the form of consumer incomes, which it simultaneously distributes to consumers. On one side of the ledger, we would have a list of total production, both capital and consumer goods and services, as measured in remunerative prices delivered within a specified period of time, say a year. This is a nation's available supply. On the other side, we would have all the incomes concurrently distributed in the form of wages, salaries and dividends. This is a nation's available demand. The relevance of a national profit and loss account for the financial facilitation of consumption under a national monetary policy is as follows. Insofar as the remuneratively priced value of consumer goods and services produced exceeds the incomes distributed in the course of their production, there is a societal profit. This profit should be monetized via the creation of debt-free credit and then issued to or on behalf of society's rightful shareholders, the common citizens. The national dividend and the national discount or compensated price are two methods for effecting this distribution. This animated series was sponsored by the Clifford Hugh Douglas Institute for the Study and Promotion of Social Credit. For more information on Douglas Social Credit, please visit socred.org or socialcredit.com.au. Be sure to like this video and please subscribe to our channel.